Over the past 30 years, I've dedicated my life to mastering the field of finance. From earning a degree in accounting and finance to obtaining multiple qualifications in financial management, my career has spanned various roles within the financial sector. Throughout this journey, one of the most transformative skills I've acquired is the ability to manage my personal finances effectively. Recognizing and breaking free from harmful money habits has been pivotal in my financial growth, and today, I want to share the main bad money habits that often hold people back, along with practical tips on how to break free from them. One of the most profound lessons I've learned is the importance of paying yourself first. This concept was first introduced to me through Dave Ramsey's book, The Total Money Makeover. Ramsey describes two approaches to handling finances: the poor man's habit and the rich man's habit. The poor man's habit involves paying yourself last. This means that after receiving your paycheck, you prioritize your rent, utility bills, phone bills, subscriptions, and social expenses. If there's any money left over, if being the key word, you save that. Unfortunately, this approach rarely results in significant savings. On the other hand, the rich man's habit flips this process. The first thing you do when you receive your paycheck is to pay yourself. A minimum of 10% of your income should be set aside for savings as soon as you get paid, treating it like a non-negotiable bill. This simple shift in mentality guarantees that you are saving consistently, rather than letting money slip through your fingers with unnecessary expenses. Some might argue that it's impossible to save when living paycheck to paycheck. However, the surprising truth is that once you prioritize saving that 10%, your mind will automatically adjust your spending habits to make your remaining funds last for the entire month. You'll find yourself saving money almost effortlessly, even when it seems like there's none to spare. Remember, the key is to invest in your future before spending on others. Paying yourself first is an essential step toward financial independence. In today's society, debt has become disturbingly normalized. People use debt to finance everything from daily necessities to luxury items like clothes and gifts. However, living this way traps you in a cycle that hinders financial freedom. My rule of thumb is simple. If I can't pay for something outright in cash, I shouldn't be buying it with credit. Credit card companies are designed to profit off of our poor financial habits. The average credit card interest rate hovers around 22%, which can quickly negate any rewards or benefits you might gain if you don't pay off your balance immediately. This directly ties back to the principle of paying yourself first. By consistently saving, you can build a buffer, ideally 3 to 6 months of living expenses, that provides peace of mind. This buffer allows you to handle unexpected expenses without resorting to debt, freeing up mental energy to focus on more important things. The path to financial security involves discipline. Start by putting aside that 10%, and over time, as your savings grow, you can shift your focus to building an investment portfolio. This approach not only helps you avoid unnecessary debt, but also lays the foundation for long-term financial success. A common mistake many people make is not having a clear understanding of their financial situation. To navigate toward financial stability, you must first know where you stand. One concept that highlights this issue is lifestyle inflation. As your income increases, so do your spending habits. The more you earn, the more you tend to spend, whether on a bigger house, a nicer car, or more lavish vacations. This cycle can quickly become a financial trap. To break free from this, you need to take control of your finances by mapping out your income and expenses. A budget tracker is a powerful tool in this regard. Your budget should clearly outline how much you earn, how much you save, remember the 10% rule, and your essential expenses such as bills, rent, and debt repayments. Keeping track of these numbers is crucial for financial planning. Regularly reviewing your budget, at least every 3 months, is essential. Monitor your budget tracker to reassess your financial goals and progress. People who are aware of their financial situation, who know their assets and liabilities, and who have a clear plan for where they want to be, are far more likely to build wealth compared to those who merely fantasize about financial success without a concrete plan. Seeing your financial status in black and white can be a powerful motivator, pushing you into action. Many people fall into the trap of indulging in expensive hobbies, such as retail therapy. While it's natural to want to enjoy life, it's important to recognize that the constant push from marketing and social media to spend money can be detrimental to your financial health. Large corporations invest billions in convincing us that we need to spend to feel happy, but in reality, accumulating unnecessary stuff often leads to financial stress. Instead of funneling money into expensive hobbies, consider redirecting those funds into savings or investments. This doesn't mean you have to give up on enjoying life. It simply means being mindful of your spending habits and prioritizing long-term financial security over short-term gratification. While saving money is crucial, it's not the only factor in improving your financial position. To truly build wealth, you need to balance saving with increasing your income. Relying solely on saving has its limitations because there's a cap on how much you can save. However, there's no limit to how much you can earn. Building wealth requires a dual approach, saving a portion of your income while also exploring ways to generate additional income. This could involve investing in the stock market, asking for a raise at work, or starting a side hustle. By focusing on both saving and income generation, you unlock the potential for significant financial growth. Remember, the key to financial success lies in balancing both sides of the equation. While cutting back on unnecessary expenses and maximizing savings is important, exploring opportunities to increase your income is equally crucial. The potential for financial growth is limitless when you open yourself up to new revenue streams. Taxes are often the largest expense people face throughout their lives. While everyone is obligated to pay taxes, many people do so without considering how they might legally reduce their tax burden. The wealthy understand the importance of tax planning, using legal corporate structures and tax strategies to minimize their tax liabilities. If you want to build wealth, it's essential to educate yourself on tax rules and how they can work in your favor. For example, investing through a Roth IRA shelters your dividends and profits from taxes. Similarly, operating as a business rather than an individual, if you're an independent entrepreneur, can provide significant tax advantages. It's important to note that reducing your tax burden doesn't mean evading taxes. It's about understanding the legal options available to you to optimize your financial situation. By minimizing your tax bill, you can redirect those savings toward investments, charitable donations, or other causes that align with your values. Knowledge is power, and understanding how to manage your taxes effectively is a key component of financial success. Once you've built a solid savings foundation, the next step is to start investing. The longer you delay, the harder it will be to achieve the same level of financial freedom. Investments allow your money to work for you, creating passive income and growing your wealth over time. It's crucial to diversify your investments to protect yourself against market fluctuations and economic downturns. Whether you are risk-averse or more of a risk-taker, there's an investment strategy that aligns with your financial goals. The key is to start early, even if it's with a small amount of money. Leaving your savings in a bank account can be counterproductive due to inflation. Inflation erodes the purchasing power of your money over time, meaning that the cash sitting idle in your bank is actually losing value each year. To counteract this, Invest your money wisely in assets that have the potential to outpace inflation. Whether you prefer low-risk investments like bonds or are willing to take on higher-risk ventures like stocks, the most important thing is to get started. Don't let fear or uncertainty hold you back. The sooner you begin, the more time your investments have to grow, and the less effort you'll need to achieve financial independence. In conclusion, breaking free from these common bad money habits can have a transformative impact on your financial future. By prioritizing saving, avoiding debt, understanding your finances, and making smart investments, you can set yourself on a path toward financial freedom. Remember, the key to success lies in consistent action and a commitment to long-term financial goals. Thank you for watching, and if you found this video helpful, please subscribe to the channel for more tips on mastering your finances.